Okay, let's unpack this then. Today, we are diving into, well, a really core concept in finance, the cost of capital. And specifically, we're tackling WACC. That's the weighted average cost of capital. Our source material here is some key lecture slides laying out the basics.
That's right. And the aim really is to get beyond just, the textbook definition. We want to understand where companies actually get their funding from, how they figure out the cost of that funding using WACC, and maybe most importantly, what makes that cost tick up or down.
Absolutely. Because for anyone following finance, you see this WACC number everywhere. It's central.
Totally central. Valuation, investment decisions, all of it.
Okay, so first things first. Where does the money come from? The sources. What do the slides tell us about the main ways companies raise long-term cash?
Well, they basically break it down into three main categories for long-term capital. First, you've got debt.
Right, borrowing money.
Yeah, exactly. The notes payable, long-term debt, like bonds, that sort of thing. Then number two is preferred stock.
Okay, preferred stock. Bit of a hybrid, isn't it?
It is, yeah. It often has features of both debt, like fixed dividend payments perhaps, and equity.
And the third main source.
That would be common equity. This is really the ownership piece. It comes from two places, essentially. Profits the company keeps and reinvests, that's retained earnings. And then also by selling new shares of ownership, issuing new common stock.
Got it. So debt, preferred stock, and common equity. Those are the big building blocks.
Those are the core components of the capital structure, yes.
And WACC, this weighted average cost of capital, is all about figuring out the cost of that specific mix a company uses.
Precisely. It's the weighted average cost of capital.
Yeah.
It's meant to be a single number that captures the average cost the company pays for all the long-term funds it uses, debt, preferred, common weighted, according to how much of each it has in its capital structure.
So it's like the blended rate?
You could think of it that way, yeah. It's the overall required return on the firm's total assets, essentially.
And this is interesting. The company's cost is also the return the investors who provided that capital expect to get on average.
Exactly. They're two sides of the same coin. The firm pays the cost, the investors demand the return.
And obviously, the goal for the company is generally to keep that WACC number as low as they can manage, right?
Definitely. A lower WACC means it's cheaper to fund projects, which, makes it easier to find investments that add value. It increases the potential for profitable growth.
Okay, so how do we calculate it? The slides have a formula I saw. Looks a little intense at first glance.
Yeah, it can look like that, but it breaks down logically. It's WACC. It's WACC, WAG1T, plus WP plus WSECR.
Right. Let's unpack those letters. The W are the weights.
Correct. WD is the proportion or weight of debt. WPU is a weight of preferred stock. And WS is the weight of common stock. They should all add up to 1 or 100%.
Okay, weights make sense. And the R's, those are the costs.
Yes, the R's are the component costs of capital. R's is the cost of debt, basically the interest rate they pay. R is the cost of preferred stock, often it's dividend yield. And R's is the cost of common stock, which is the return shareholders require.
And the T is just the company's corporate tax rate.
Right.
And that 1T bit, that only applies to the debt component. That's important, isn't it?
Very important. That 1T reflects the tax shield from debt, because interest payments are usually tax deductible. It effectively lowers the real cost of debt to the company. So you use the after-tax cost of debt in the WACC calculation. Equity returns aren't tax deductible, so their costs, R and Rs, don't get that adjustment.
That makes debt look a bit cheaper on an after-tax basis.
It does, which is a key reason why companies use debt financing. Now, the source material gives a specific calculation example, which helps make it concrete.
Yeah, let's look at that. It assumes, 30% debt, 10% preferred stock, and 60% common stock for the weights. And the costs given are 9% for debt, 9% for preferred stock, and 14% for common stock, and a tax rate of 40%.
Right, so plugging those in. For debt, it's the weight, 0.3 times the cost, 9%, times 1 minus the tax rate, so 1.4 or 0.6. That gives you 1.62%.
Okay, 1.62% for the debt part.
Then preferred stock, weight, 0.1 times cost, 9%. That's straightforward, 0.9%.
9%.
And common stock, weight, 1.6 times cost, 14%, it comes out to 8.4%.
Right. So then you just add those three pieces together, 1.62% plus 0.9% plus 8.4%.
Exactly. Sum those up and you get the WACC for this example company, 10.92%.
Okay, so that shows how the different costs and proportions blend into that one single WACC figure.
Precisely. But, it's crucial to remember this isn't a fixed number. The slides point out that WACC can change based on several factors.
Right, it's not static.
Not at all. And they split these factors into two buckets, basically. Things the firm cannot control.
Like the wider economy, I guess? Interest rates and stuff?
Exactly. Market conditions are huge. The general level of interest rates, inflation expectations, market risk aversion, even regulations can impact component costs. And, of course, tax rates set by the government directly affect that after-tax cost of debt.
Okay, so market forces and government policy are outside influences. What about things the company can actually manage or decide?
Well, there are definitely levers the firm can pull. The most obvious one is its capital structure policy. Deciding how much debt versus equity to use directly changes those W weights in the formula.
Makes sense. Change the mix, change the average.
Right. Also, the firm's dividend policy can sometimes influence the cost of equity. And this is a big one, the source highlights, the firm's investment policy.
How does investment policy affect WACC?
Specifically, the riskiness of the projects the company chooses to invest in. If a company's taking on much riskier projects, investors, both debt holders and equity holders, are likely to demand a higher return to compensate for that increased risk. That pushes Agura's and especially AS.
So riskier business activities can directly lead to a higher cost of capital.
Yes, that's the connection the material makes. Higher risk generally means a higher WACC, all those being equal. It's a fundamental trade-off.
What's fascinating here is how this single WACC number ends up reflecting so much, not just market rates, but also the company's strategic choices about financing, dividends, and even the kinds of projects it takes on. It's like a financial summary of risk and strategy.
It really is. It synthesizes a lot of information.
Okay, so what does this all mean for you listening? We've seen that companies fund themselves through a mix of debt, preferred stock, and common equity. WACC is the calculated average cost of that specific funding mix. We looked at the formula WDRD 1T plus WPAP plus loose RS, paying attention to those weights, the individual costs, and that crucial tax adjustment for debt. The example put numbers to it, showing how it blends together.
And then we touched on the factors that can push WACC up or down, some external, like interest rates and taxes, and some internal, like the company's financing decisions, and importantly, the risk level of its investments.
Right. So wrapping this up, that last point raises a really interesting thought, doesn't it?
It does. It sort of leaves us with this key strategic question that builds right off the source material. If a company's investment decisions, like choosing potentially high growth but riskier projects, can directly increase its WACC, well, how does management actually make that call? How do you balance the potential rewards of those risky growth opportunities against the very real impact of making your overall cost of capital higher? That balancing act is pretty central to managing a business for value.
A fundamental challenge. Definitely something to think about.